Today, we're diving into two of the most overlooked software giants. These stocks have massive upside potential, and Wall Street is completely missing them. By the end of this video, you will understand exactly why these two stocks deserve a spot in your portfolio. We'll break down what makes these businesses so powerful and why they're trading at bargain prices. We'll also touch on the key growth catalyst that will send these two stocks soaring over the next few years. If you want to learn how to build wealth with these top-tier software stocks, stick around until the end and I'll show you exactly how I'm trading them and utilizing options to generate monthly income utilizing leverage safely. Should be a fun video for you here today. I appreciate you all. One thing I ask, one thing only, smash that like button down below. If you like, you're certainly welcome to subscribe as well. We're at an all-time high for subscribers, and I appreciate each and every one of you. So with that, let's get started. The first stock we're going to talk about is Adobe. Adobe has strong fundamentals and has had consistent outperformance. They've had 10 straight double beats on earnings. Double beat means earnings beats as well as revenue beats, so the top and bottom line. Adobe has consistently exceeded both revenue and earnings expectations for 10 consecutive quarters, demonstrating operational excellence and reliability. The valuation, the current forward PE is just 18, so it's way below many high growth software peers. The PEG ratio, or price to earning to growth, is about 1.2, indicating reasonable valuation relative to growth. And the 52-week high and the target. The stock hit a 52-week high of $587 and is currently trading near about $370, making it an attractive buy the dip opportunity, especially after a recent Citibank downgrade causing a sharp pullback. The gross margins are incredible. Adobe maintains a legendary 88 to 89% gross margin. It's among the highest in the software sector and a net margin of around 30%. The financial strength of the company has strong cash flow and operating cash flow, supporting ongoing share buybacks and a robust balance sheet. Adobe also has quite a few growth drivers behind it. It has recurring revenue. Adobe's subscription-based model ensures a steady, predictable revenue stream. The earnings per share growth is consistent, and strong execution have built investor confidence. The launch of the standalone Firefly app for Android expands Adobe's reach in the creative and marketing space, offering powerful AI-driven tools for creators and marketers. With over 30,000 employees focused on innovation, Adobe is leveraging AI to enhance its product suite and drive efficiency. Adobe has a track record of acquiring smaller companies to fuel innovation and growth. So there's quite a bullish outlook for Adobe. Analysts project 12% annual revenue growth and 14% net income growth over the next several years. So that's double-digit growth. Their net income margin is expected to remain strong, supporting a fair PE of around 30 and a potential stock price of $950 to $1,000 by 2029. With a healthy operating income, Adobe is well positioned to continue to share repurchase programs and boost EPS and shareholder value. And Adobe's business is resilient to macroeconomic shocks with a sticky customer base and best-in-class products in photos and editing. Now, just like Adobe, there's a strong bull case to be made for Salesforce, ticker symbol CRM, and it's one of my favorites. Salesforce is the undisputed leader in customer relationship management software with a dominant market share. The company has delivered consistent revenue and earnings per share growth, with recent quarters beating analyst expectations. Salesforce trades at a forward PE of about 23, significantly lower than many software peers, making it undervalued given its growth profile. Over 90% of Salesforce revenue is recurring, providing stability and visibility. Salesforce has many strategic strengths and catalysts. Salesforce Einstein AI platform and recent investments in generative AI are driving new product adoption and upsell opportunities. The Salesforce ecosystem, including Slack and MuleSoft, creates cross-selling and integration opportunities, deepening customer relationships. It has strong free cash flow, and it supports ongoing investments, acquisitions, and share repurchases. With where Salesforce is trading at right now, there's a huge bullish outlook. Analysts expect high single-digit to low double-digit annual revenue growth over the next few years. Operating and net margins are expanding as Salesforce focuses on efficiency and scale. The company's share repurchase program is reducing share count, boosting EPS and long-term shareholder value. Compared to Microsoft and Intuit, Salesforce trades at a discount on a forward PE of 23, suggesting significant upside potential. So why are both of these stocks screaming buys right now? Well, both Adobe and Salesforce trade at lower multiples than their closest competitors despite superior growth and margin profiles. Their SaaS business, software as a service, business models provide stability, predictability, and strong cash generation. Both companies are integrating AI across their platforms, unlocking new growth opportunities and operational efficiencies. Active share buyback programs enhance earnings per share and long-term value. And Adobe leads in creative software, while Salesforce dominates in CRM and enterprise cloud. These factors make both Adobe and Salesforce strong companies, and I'll show you exactly what I'm doing and how I'm playing them going forward, and we'll jump into it on the option trading platform right now. All right, guys, I'm on the Tasty Trade option trading platform and brokerage. It's one of my favorites for trading options, super intuitive, and there's a link down below and benefits if you go through my link. So with that, let's jump in. The first one is Adobe, ticker symbol ADBE, and we punch it in right here in the upper left. And we're on the trade page. Now this brings up the option chains, and you can see these are the regular option chains. You can actually switch here between all expirations, so you can go all expirations, and it brings up the weeklies as well. But I do like to trade the regular option chains, the monthly that expire on the third Friday of each month. So I'm going to stick with those. They're a little bit more higher volume, and that makes this the options more liquid. So I like to go out 30 to 45 days to expiration. So we're going to open up this August 15th. You can see right here in the middle, it's 35 days to expiration. We'll click on this and open up that option chain. Now what we're going to do today, because this is a fairly high priced stock at $365, so one option contract controls 100 shares of stock. So if you were to purchase one option contract, it would cost let me start over. If you were to purchase 100 shares of stock of Adobe, it would be $365 times 100, or $36,500, $567. We're going to control that same 100 shares roughly with an option contract. So what I'm going to show you in this video is how we sell a put credit spread. We're going to do that in both Adobe and CRM, which is Salesforce. And this utilizes leverage to bring in monthly income. By selling, we get paid. So what we're going to do is we're going to look at the puts on the right. So puts are on the right, calls are on the left. And we are going to sell the, let's look at the 360 put right here. 360 strike is trading at 365 right now. And on the left here, this is bid to sell. So we're going to click on that. And then we're going to buy at the same time, same trade, the 350 strike put as well. So we've sold a put that's closer to the money, being the 365, and bought a put that is $10 away, $350. So the max we could lose, because this put that we're buying is protection. So our max loss is this $10 width of the strike minus the amount that we collect up front when we place this trade, which is $335, $338 right now is the mid price. So once we hit review and send, this trade is placed, and $335 is automatically, right when we hit review and send, it's placed in our account. Now the max loss again is that $10 width minus the $335. So you can see right here, max loss $665. So that's the beauty of trading options. Now, if we go to curve mode, this is what I like about the Tastytrade platform. Most platforms and brokerages don't have this, but we can go to curve, and you can see right here the profit zone in green. And you can see no matter what, we're capping our profit at $335. I like to collect 1/3 the width of the strike. So on the $10 width, I like to collect around $335. $333 would be exactly 1/3. Now, what can happen, even if this stock price were to drop down to $360 at the end of this 35 days to expiration, we still keep this full $335 that we collected up front. So that's the beauty of options. The probability of profit is 62%, so it's above 50%. Typically, I think it's a little bit higher than that. We're collecting 300. No, you know what? We can look right here on the delta. So our delta is 41. So yeah, it's around 62, 61%. It's 1 minus this 41 delta. So basically 60%. So, I mean, I'll take that. We're in this for the long term. Now, here's the thing. If we do get tested and the stock price does come down, then what do? We just roll to the next monthly option chain, and I'll show you how to do that in another video. If you want to hear about that, just comment down below, and I'll make another video about rolling. But this is how you place a trade, a put credit spread, and credit, because we collect that credit when we place the trade, and we hit review and send and place the trade. All right, guys, the next one is Salesforce, ticker symbol CRM. So I'm going to go a little bit quicker through this one, but it's exactly the same way that we place the put credit spread, or we sell the put credit spread. So we punch in CRM up here, and we're on the trade page, and I'm going to open up the August 15th, 35 days to expiration chain. We're going to go, it's trading at 259. So what I'm going to do, I'm going to actually go right at the money. If you go 250, 240, that's $10 out of the money, because we're basically trading at 260. Right now the price is 259, so we're right near 260, and we're only collecting $2.34 if we were to place this. Remember how I said I like to collect 1/3 the width of the strike? Right. So what we're going to do is we are going to go to the 260, and then we're going to sell that and then buy the 250 right here. So that's $10 wide. We're going to collect a little bit more because we're going a little bit in the money. So $4.03. So that's $400 that we're going to collect as soon as we hit review and send. Now, again, if you go to that curve mode, and you can look right here, and you can see the profit zone down to 260, we keep that $400 profit, and we actually collect all the way down to 256. So it's 260 minus the $4 is our break even, down to 256. So it could even drop from where it's at now, and we still make money. So we hit review and send and place the trade. All right, guys, be sure and download the free options workshop in the link below. Remember to hit like and subscribe. If you like this video, be sure and watch this next one.